Right, let's kick this off. So certainly an interesting time in markets at the moment. Obviously just the week following a big crash in the stock indices, and today we've got some big US inflation data, many calling it the most important inflation data in a decade, because of the implications it could have for bond yields and for wider markets. But we're not actually going to be talking about that stuff today. This is a webinar discussing risk. Now, I think you probably read the risk warning we have on the screen here, so I'm going to deviate towards the topic at hand, and that's how to calculate risk in trading. Now, there are many different avenues you can go down in terms of calculating risk. It can get very complicated. There are the PhDs at the banks trying to build models to calculate all the various types of risk around in the market. This webinar is nothing along those lines. This is very much a practical webinar for the personal trader, how to just make sure that you're controlling your own risk in the trades that you're placing, and talking about firstly just some lighter stuff and why you'd want to do that and why it's important. Then a bit of nitty-gritty in terms of calculations, particularly when it comes to forex. So you'll have to bear with us through that, but it will be worthwhile, I think. And then just kind of putting it all together in terms of how do you place a trade at such a size as to minimize the amount of risk to yourself so that you can keep on trading and maximize your opportunities for when the trade goes in your favor. That's what it's all about. So I sort of summarize what we're looking through with those topics covered, but as you can see there, it's what is risk and why calculate it, why controlling risk is so important, the 2% rule I'm sure you may have heard of, a 5-step risk calculation process, and then some of the kind of specifics in terms of risk calculation for forex, CFDs and spread betting, then stop losses and position sizes. And then what I should have put at the end there is if there is any Q&A, obviously I'm happy to go through that as well. So what is risk and why calculate it? For our purposes, risk is the likelihood of losing money, right? So we all do understand it on some level that trading obviously is a game in which you can lose money as well as make money, but it takes a certain amount of getting your head around it. So the way I would categorize the kinds of loss you can deal with in trading is the expected and manageable loss. That one we like. Number 2, the unexpected and unmanageable. That one we don't like. So by calculating the risk for each trade before we enter it, most of the risk that you'll be accepting by trading will be of that first type, the kind of expected and manageable risk. I.e., we kind of know that we're putting this much risk on the table and we could obviously lose it. But we're comfortable with it, well, we can manage it, it's not a problem for us. Rather than the second type, which by calculating the risk beforehand you can mostly avoid, which is this kind of unexpected and unmanageable where you get caught off guard, it throws off your trading plan, and it's very difficult to manage. So I'll talk about that a little bit more here. So silly phrase time, trading's a numbers game, one of those annoying things that you hear thrown around. But it is so true. So you will win and lose trades. The aim is to win more than you lose. And so this next sentence is key here. You're not trying to avoid losing altogether. So we all know that's impossible. There are some maybe algorithmic trading firms that are basically gaming the market and never lose a trade. That's obviously not us. What we're doing here is we're accepting that a certain number of our trades are going to be losers in order to get to the winners. You have to have some skin in the game, and that's going to involve some losing trades, but you want to minimize those so you can maximize the winners. So the key here is why we have stop losses, why we want to control our risk, is that we want to maintain our capital. We want to make sure we have money in our account still during those losses so that when the winning trades come around, we can fully benefit. If you take too much risk on one or two trades, wipe out a good chunk of your trading capital, you can no longer place the kind of size trade that would benefit you when that winning trade comes along. So to summarize all that, 3 reasons to control your risk, just to make sure that you stay in the game, so you've still got some money in your account. Smaller drawdowns let you sleep easier. It's we've all been there. We've had a large loss, or maybe there's we've taken the loss, and that's not much fun. Or we're just sitting on a large open loss, and then it's actually genuinely quite difficult to go to sleep when that loss is fluctuating up and down in your account. And number 3, this is a kind of subtle point, but it allows you to make better use of leverage. Because what would you ideally want? A trade which has a potential 10% drop here, or maybe 10% gain, and so your equity curve, if you like, looks like if in each trade's going up and down 10%, hugely with massive gyration. Or do you want a very smooth 2% up and down, for example, equity curve that almost looks like a straight line? There's very, very few curves in it, but just using higher leverage. And so actually you stand to use, you stand to gain more because you're able to leverage your account a bit more. But you're able to do that because you're not facing some massive 10% swings in your account value. You're only facing those little 2% swings. So by using leverage, you can obviously push that out further. So hard to explain that unvisually, but I think you get the point. So this is this 2% rule for your capital at risk. Only risk a maximum of 2% of your capital on any one trade. So, you may not have all your capital in one account. Maybe you've got a couple of different accounts. So, that's 2% of your total capital available in the market. Obviously, within that asset class that you're trading. So if you're spread betting money, maybe you have a couple of accounts, but 2% of that total money on any one trade. And then an extension of that, ideally, all open trades would not necessarily exceed 5%. Now, you can push that to 6% if you're doing 2% on 3 trades. So obviously, if you've got a few trades going at the same time, you kind of need to dial down the size of how much you're risking. Now, there are caveats to that I'm going to talk about. You can see that I sort of almost go against that at the bottom of this page here, but I'll get to that in a second. So 2%. So some people are much more risk averse, and they can trade 0.5%. For me, that just doesn't. Obviously, if you're risking 0.5%, you're only going to be making that 0.5% of your capital, or 1% of it. It's going to be quite slow going to make the gains. Now, maybe if you trade a bit more frequently, then actually perhaps that lower value makes a bit more sense. 2% I think works quite well for a kind of swing and position trading system. Obviously, if you go above 2%, 3%, 5%, of course your gains stand to be larger. But imagine if you are risking 5% of your account on each trade, 3 losses in a row, not unusual. You're down 15%. So that's quite a chunky drawdown to experience, and it's certainly not unusual to have 5 or 6 losses in a row, during a bad period. Even if you're following your system perfectly, obviously you can have 5 or 6 losses in a row. If you're breaking your own rules, that's actually probably the norm. But if you're following your system, following your rules, you can still have those drawdown periods, and you don't want to be down a quarter or a third of your account. So the best way to avoid these emotional response to your losses, like the sort of things that not only will you lose that larger amount, but you'll actually jump back into the market and do a revenge trade to try and make it all back up, something you haven't planned very well, and you actually double down on the loss. To avoid that kind of situation, make sure the size of one loss won't bother you. So just as an example, if you have $50,000 in the account, $1,000, of course you don't want to lose it, but 2%, it's not really going to throw you off. You've still got $49,000 in the account, pretty much where you started.
A $10,000 loss out of a $50,000 account, now that is that's again quite chunky and pretty hard to bounce back from. You're going to be a bit shell-shocked from that, and it's going to probably impact your future trades. Not to mention it's just harder actually to make that money back because it's just that much more. Now, this is what I was talking about before. Some people like to vary the size of the position for different trades. That's all well and good. One example would be if you're feeling very confident about the trade, you'd risk 3%. If it's not the best setup, you risk 1%. Or if you've had a string of winners, you maybe risk more, or you risk less. Or if you've had a string of losers, you risk more, risk less. For me, I just keep the risk on each trade exactly the same. Because in my experience, the trades that I feel the most uncomfortable with tend to be the best. So it's just not actually logical that I would want to bet a small amount on those, for example. Each trade has an equal value in your account, so if you don't want to get and often if you do fluctuate in my experience at least, if you do vary the size of how much you're willing to risk on each trade, you'll get to these kind of situations where maybe you have 2-3 losses in a row of risking 2%, and then you get a winner where you're only risking 1%. So you don't catch up on the losses like you otherwise would have. So it always seems to work out that way, rather than the trades where you risk 1%, you lose, and then you win the one with 2%. It just never. Sod's law says it never works out that way. But it's something to experiment with for sure. Different strokes for different folks. So this is that kind of 5-step risk calculation process for just determining how much to risk on a trade. Know your risk tolerance, how much you're willing to risk as a percentage of your account. So we've just said about 2%. Decide your entry price, decide your stop loss. So that needs to be, however you do it in your system, the points difference, the number of pips difference between your entry and where you'd cut out of the market at a loss. Or if you base it on the price, then you need to know that points difference again. And then number 4 is where is what we're going to discuss in a bit more detail in the webinar here, is understanding the points value of each either forex lot, CFD, or spread bet. And I'm going to try and cover all 3 gambits there. There's obviously a bit of crossover between forex and CFDs. Forex in essence kind of are CFDs, but there are CFDs that aren't forex, so a bit of overlap there obviously. And then spread betting, which you'll find if just for this particular purpose is a lot easier. Then well, obviously spread betting only available to residents of the UK and a few other territories, I believe. Now and then the 5th and final point there is calculating the necessary position size to match your risk tolerance. So this is what it's all about, is basically knowing how many points you're willing to risk on the trade, deciding I want to buy here and I want to sell here if it goes wrong, and just knowing how big can I trade so that little, if it does go wrong, it's just that 2% of my account. That's what the crux of what we're trying to do here. All right, so this is where it gets a little bit painful. I'm sure you guys can handle it, so let's go for it. A quick one on just what the idea behind forex is and what you're actually doing when you're trading forex. So a forex pair consists of a base and a variable currency. So obviously there's always 2 currencies involved. The first currency is the base, and the second is the variable. So in euro dollar, for example, the base is euros, the variable is dollars. We use the word lot in forex to describe how much you're buying or selling. So lot is a bit like an alternative word to a contract. Then we generally tend to deal in standard lots and mini lots, and you can even get micro lots as well if you're trading on MT4, for example. So one standard lot is exposure of 100,000 of the base currency denominated in the variable currency. So it'd be 100,000 euros based in dollars, for example. So and the mini lot is 10,000 of the base currency denominated in the variable currency. So that's all well and good. So we just know when we're placing, one normal lot in forex, we're trading 100,000 euros, for example, and then the exchange rate gives us the value in dollars. Fine. Moving on to the pip values, because this is the crux of what we want to know. Okay, so what does trading 100,000 euros mean for how much I'm betting per point? So how can I then translate that back to knowing that I've got a 50-point stop loss and knowing how much I can risk per point? That's kind of that's the thought process in the head that we're trying to do here. So the pip is typically the fourth significant figure. In the case of euro dollar, it's 0.0001 is the pip. But in dollar yen, a bit of an exception. The other yen pairs, obviously, because the yen is so weak against most major currencies, it's actually 0.01. So obviously you've got those other significant figures in terms of hard numbers rather than the decimals. So this is a key one here to understand. Now, I should juxtapose all of this, is that this is more for your general understanding. Luckily, on the LCG Trader platform, this is pretty much all kind of calculated for you, but it's good to generally understand what you're dealing with. And even if it, and obviously you can get third-party websites and things that will do these kind of calculations too. So the value of 1 pip is 1 pip as we're expressing it in actual currency, and then divided by the exchange rate and the size of the trade. So an example, one standard lot of euro dollar at the price of 120, we would do one lot, which is 0.0010001, divided by 120, which is the exchange rate, times 100,000, which is our one standard lot. And that gives us a value of 8 euros 30 cent. And if we want to convert that into dollars, then it gives us $10 per point. So this is a good one to generally remember when you're trading forex, particularly if you have a dollar-based account. This all makes life very easy when you're trading the dollar as the variable, sometimes called counter currency. It's always just $10 a point, so very easy to remember, very easy to calculate. If you have your account based in another currency, as I mentioned at the bottom of the screen here, then you basically would convert either from this euro price, or you would just remember that it's $10 per point in the case of euro dollar, pound dollar, etc., Aussie dollar, that's $10 per point. Convert it to your own currency to know how much you're betting per point. Now for dollar yen, same exact thing again. We've got a say we're using 10 standard lots this time. So last time it was just 1. Say we're doing 10. So what we then do is, I think I've slightly miswritten it actually, but obviously 100,000 being sort of 1 lot, and so what we'd actually be looking for is 10 lots is actually 1 million. So you're doing 0.1 times 100,000, 110, which is the exchange rate, and I'm sorry, I should have written here 1 million, but obviously I just wrote that 10 for 10 lots. That gives you $90.90 per point. So obviously you can see here, because the dollar is not the second currency, it's not the variable currency this time, it's the base. That gives you a slightly odd number per point. So it's not $10 per point, it's not $100 per point that you would expect for 10 standard lots. It's actually 90.9, so it's a bit less. So it's this little calculation into points that you need to have in mind when you're deciding how many points you're going to risk on the trade. This is kind of the first calculation you make when it comes to the forex market. Now we'll do a little example in just a moment. So moving on to CFDs. So as I said, there is a bit of crossover with with currencies. There obviously are currency CFDs. I've talked more about sort of indices here, but I've also mentioned that obviously futures like Brent crude oil. So what you're doing with a CFD is you're holding a notional position in the market by buying or selling lots. Again, that same phrase as forex trading. And lots are typically some multiple of the value of the underlying of what you're trading. So as an example, one lot of Brent crude oil is 1,000 barrels. One lot of Wall Street, which is the CFD for the Dow Jones, is just 10 times the index price, the stock index, which in this case is our pricing of the Dow Jones we call Wall Street. So that's kind of the notional, that's what you're dealing with in terms of what a lot is, and so that can help determine, based on the size of what you're trading, what the notional value is. Like, say you're trading 10 lots, how much is that? You're trading 25 lots, how much is that actually worth when you're trading these different things? So I can give, so the notional value is the amount of lots times the contract size. So as an example, one lot of Wall Street, if the price is 25,000, is, as we said earlier, it's 10 times the index price. So 10 times 25,000 gives you the size of your trade that you're placing. The notional value is 250,000. So it's all written in maths, and sometimes it can, suddenly this is going to get mixed together in your head. But all we're saying here is that when the price of Wall Street is 25,000, we buy one lot. The size of our trade is $250,000. That's all we're saying here. Now, when it comes to the DAX, obviously that's a European index. So, say the price is 12,000 in the DAX. If buying one lot of the DAX, we know that one lot of the DAX, same as Wall Street, is 10 times the index price. So it's 10 times 12,000, but this time it's euros. So 10 times 12,000 euros gives us a position size of 120,000 euro. So written out slightly differently here, but we've already kind of got a bit of an example going. So for example, if we're looking to make a profit on a certain trade, what's that going to look like? So if we buy one lot of the DAX at 12,000 and then we sell it at 12,025, so that's an extra 25 points on the DAX, and so that 25 point profit is just going to be 10 times the 25 points, gives us 250 euro. Now if we do, now this is kind of the key point here, as obviously that's talking in terms of a profit, but if we reverse things here, and you say we're looking at a 25 point loss on one lot of the DAX, then then you're looking down at minus 250 euro. So again, the kind of idea is that we're trading the DAX, so it's in euros. So obviously the difference here being that if your account is based in a different currency, you need to kind of convert that the idea of that profit and loss into your own currency. But if that $250, you need to in this example, we need to kind of just work out how it relates in some way to the size of your account, and to that, again, back to that 2% idea. So this is just a sort of random example, 25 points. In a minute we'll talk about what you'd the steps you'd go through for making sure that that number of points you're willing to accept and the number of contracts fits in with your 2%.
So I mentioned that spread betting is a fair bit easier than forex or CFDs, because really basically the whole difficulty in those other methods of trading, types of account, is just working out how much you're betting per point, so that you can decide on how much your stop loss is going to be worth in actual dollars, and how much that relates to your 2% of your account you're willing to risk. But in spread betting, you're betting per point. That's kind of how it works. So basically the value per point calculation has been done for you. In essence, you're kind of trading strange sizes of contracts that perfectly match up to make sure you're trading a certain number of pounds per point. So when you're calculating the notional values, i.e. how much is the size of your trade worth, you basically, if you're betting £1 per point on the DAX at 9,500, for example, it's just £1 times 9,500. That's the value of what you're trading, is 9,500 when you're betting £1 per point. So a relatively small position, actually, more like a kind of equivalent to a mini lot in forex, not the equivalent of a standard lot. Then you'd be trading more like £10 per point to get that kind of equivalent in terms of size of trade. So the profit potential here, similar idea with the CFDs, but if you're betting £1 per point on the UK 100, for example, at a price of 7,000, and then you sell it at 10 points later at 7,010, you're literally just doing those 10 points times £1, which is what you're betting per point, and you're winning £10 for that. And then risk works just the same way. For example, say if we were only willing to risk 10 points on the trade, we buy it at 10,000, it drops to 6,090, 10 points lower. Again, we're just betting £1 per point, and so that 10 points loss gives us a loss of £10. Again, guys, flag me up if anything's not too clear. Send me a direct message or send a message to the group. I'm happy to answer any specific questions, but I'm hoping from your lack of questions so far that it's all vaguely clear. So if we deviate back to the with the knowledge that we now have in terms of values of contracts and kind of associated risk, let's give this example of that we have a $10,000 account. We want to risk 2% of it on our trade. So we know that 2% of a $10,000 account is $200. So basically, whatever the size of our stop loss is, what we're concentrating on is that $200. So the kind of, I guess the concept of which I haven't really elaborated on yet is that we're going to vary, if you use different size stop losses, then you want to vary the number of contracts you're buying. You don't want to vary how much you're risking each time. Just because your stop loss is bigger one time, say you've got a really great trade set up, but really you need to risk 100 pips in terms of a stop loss just to be safe, whereas normally you risk 50 pips. You don't have to risk double the amount. You just cut down the number of contracts you're trading by half, and then you're risking your normal amount again. So in this example, it's $200. That's what we want to get to as close as possible. Now, as it is, contracts are in certain sizes, so unless it's spread betting, which is all quite straightforward, you're not going to hit that $200 on the mark, but within a certain error, range of error of plus or minus 20 odd dollars from that $200, you're risking about the same each time, right? So say we want to buy the euro dollar at 120.
with a 100 pip stop loss, that stop loss is obviously then going to be down at 119. And so we now know, right, that one mini lot is $10,000, and in the case of euro dollar, it's always quite easy. It equates to $1 per pip. So our risk of $200 divided by a stop loss of 100 pips mean we can basically risk $2 per pip, or just trade 2 mini lots, right? So that's for 100 pips. Now, say for example our stop loss was 50 pips. Obviously, then if we're still willing to risk our $200, instead of trading $2 per pip, we can actually double that, because there's obviously half the amount of pips. You can double the amount of risk per pip. So that would then be $4 per pip, or 4 mini lots of forex. Okay, a question from David here. So the question is, on the LCG trader platform works out the costs, hence the monetary value rather than the lot size used on MT4. So I guess the answer, I'm not going to kind of directly answer the question in a way, but basically LCG Trader and MT4 have the availability of doing either CFD trading or spread betting, depending on your region. So I think, so basically it's going to depend on which account type you have, I think, is what your, maybe I haven't quite got your question there, David. It's I think in both accounts you can sort of see what you're risking there. Maybe rephrase, David, because I feel like I bodged that answer. And then Trevor's just asking, do you have a rule of thumb for the distance to set a stop loss and take profit? So I hope part of what this this webinar is showing you is that actually you can vary the size of your stop loss, and the key thing is that you're risking the same pounds and pence, or dollars and cents, or euros and cents amount per trade. So it's that real money amount, obviously, that determines the risk you're taking, not just the size of your stop loss in points. As it happens, Trevor, just to answer your question a bit more directly, I'm a slightly longer term trader, and so for me the stop losses tend to be between 50 and 100 points, depending on the market. In forex, between 50 and 100 pips. I would say rules of thumb, it's going a bit off topic here, but trading on a 5-minute chart, you're probably talking 10 pip stop losses. On an hourly chart, like a 60-minute chart, you're probably talking 30 pip stop losses. 4-hour chart, 50 pip stop losses to 60 pip maybe, and daily 100 pip to 200 pip. That to me has just been a kind of general guide point, more based on just how much the market swings up and down. So that would maybe be based on euro dollar. With pound dollar, maybe you stretch it out a bit because it's a bit more volatile. So yeah, David, so David's just followed up the question saying, so when you place a trader on the LCG Trader, you choose £10, for instance. On MetaTrader, you choose 1, which is 1 lot. Yeah, and so you do understand that, right, David? Yeah, exactly. We do have, well, just to clarify, that we do have spread betting on MT4, so there should be the capability of you actually betting 1.0 in a spread betting account would actually amount to the pound per point
rather than a one lot. So there would be a slight difference in value there, because obviously one pound per point is not going to perfectly, because in the case of euro dollar, for example, we know that 10,000 would be $1 per point, right? So obviously $1 per point is going to be different than a pound per point. So you're going to be trading a slightly larger size contracts in that spread betting example. It's more a difference between spread betting and CFDs. CFDs, you're trading contracts. Yeah, so I would say it's probably, in answer to your question, it's more difference between CFDs and spread betting rather than a difference in the platforms, because you actually have the options of both in either platform. Typically, for most people out there outside of the UK, when you're trading CFDs on MetaTrader or on the LCG Trader, you're going to be dealing with lots, not this kind of betting per point idea in spread betting. So in which case it's always going to be contract sizes of 10,000, 100,000, etc. So I hope that I hope that clears that up. So there's a lot to get through there, chaps, but it's a kind of long, elongated way of just talking about this idea of setting, the amount you're willing to risk per trade, and just deciding the right size of contract and varying the contract each time according to your. Obviously, if you have the same size stop loss each time, you only really need to do this calculation once, and hopefully if your account grows in value, you slightly adjust up over time the number of contracts you're trading. But if you do, especially if you do want to be able to vary the size of your stop loss, and maybe your account value varies a bit if you take some money out, put some money in, win a bit, lose a bit, it's good to be able to have these calculations in mind, just so you're always risking proportionate to how much you can afford to risk, just to keep things nice and level and balanced, so that for all the reasons we talked about, control those risks and give yourselves a chance to take advantage of those winning opportunities. So we will do another webinar which kind of builds on these ideas in terms of risk management. So that will go into more things like 2-to-1 risk to reward ratios, the benefits of lots of winning trades versus the occasional big winner, and various alternatives that you can do, and also what you do within a trade, how to kind of minimize your losses. For example, a lot of people move their stop losses to break even, scale into and out of positions. We'll have a separate talk about that in a risk management webinar. But for today, that is our webinar on calculating risk in trading. I hope it was useful. Thank you very much for attending, everyone. It's Jasper signing out.